Welcome to the CFO channel. My name is Ellie and I simplify accounting and finance concepts for founders and investors. One of the most confusing concepts for a lot of business owners, investors, and students trying to understand accounting is working capital. In this video, we'll go over an overview of what working capital is, so hopefully this concept won't be confusing anymore. Now, the textbook definition of working capital is that it is current assets minus current liabilities. What are current assets? Current assets are things like cash, accounts receivable, inventory, everything that is considered current assets on a company's balance sheet. What are current liabilities? There are things like accounts payable and short-term debt. In order to calculate working capital, what you need to do is basically add up a company's current assets, and then you deduct current liabilities, and the resulting number, whether it's positive or negative, should be the company's working capital. Now, working capital allows you to very quickly gauge the financial health of a particular company. If a company's current assets are greater than its current liabilities, then that's a good thing. That means it has a healthy working capital position. However, if a company's current assets are less than its current liabilities, then this isn't a very healthy position to be in. Why is that? Because if your current liabilities are greater than your current assets, that means that you don't have enough cash to meet your current liabilities. Let me explain. Whenever you look at a company's current assets, a lot of these assets can be converted into cash pretty quickly. So cash, for example, is just cash. It's money sitting in your bank account. Accounts receivable can be converted into cash pretty quickly as soon as your customers pay their bills. Things like investments can be sold off and then converted into cash. If you have inventory as a current asset, that can be sold to customers, which then gives you cash into the business as well. So a lot of current assets can be converted into cash, which can then be used to meet your current liabilities. If you think about this logically, if you have $100 in current assets that you can convert it to cash tomorrow, however, your liabilities are $200, you will never be able to meet your liabilities because you just don't have the cash available to meet those liabilities. And that is why, if you're in a position where your current assets are less than your current liabilities, you're a company that's in a bit of a pickle. Now, just as a very practical example, let's take a look at Apple's financial statements to see what their current working capital position looks like.
Okay, so here is Apple's balance sheet. If we focus on two sections, number one, current assets, and then current liabilities. So if we look at their current assets section, you can see that they have all of these assets. They have cash, marketable securities, accounts receivable, inventory, etc. All of this adds up to 134 billion, almost 135 billion. If you go over to their current liabilities section, you will see that they have liabilities such as accounts payable, other current liabilities, etc. This adds up to 125 billion. So if you just do some quick math here, 135 billion almost minus 125 billion, clearly their current assets are greater than their current liabilities, so they have a positive working capital position whereby current assets are greater than current liabilities. So this is a very healthy position to be in.
Now, the other place where working capital shows up in a company's financial statements is on the cash flow statement. The company's always making a few working capital adjustments to profit in order to calculate cash flow. Why do they make a lot of these working capital adjustments? Well, it's simple, really. A lot of working capital adjustments are the results of cash going out of the business or cash coming into the business. Therefore, if you're trying to determine a company's cash flow position, you will need to make adjustments for these working capital movements. Now, let's look at some common adjustments that are made on the cash flow statement for working capital. Number one, inventory. If inventory increases from one year to the next, this means that a company basically used cash to pay for this inventory. If the inventory balance increased, means a company added to its inventory, that means that a company had a cash outflow. So if you look at the cash flow statement, what you would do is start with profit, basically deduct any type of increases in inventory in order to get cash flow. If inventory decreases from one year to the next, that particular decrease is added to the cash flow statement because that's an inflow of cash. What this means is that you took the inventory you had on your balance sheet, you stole it to your customers and received cash, hence an inflow of cash, and that inflow of cash is added to profit on the cash flow statement in order to calculate cash flow. The second most common adjustment that you see on the cash flow statement is an adjustment for accounts receivable. Accounts receivable are basically any sales that you make to your customers that are on credit. So let's say you sell a particular product or service to your customer and they have 30 days to pay for that product. That would be recorded as an accounts receivable. If the accounts receivable balance increases from one year into the next, this is typically a use of cash because your customers owe you more money. You're therefore extending more credit to your customers. You're making a lot of these sales, however, you're not getting the cash into the business. Therefore, a lot of these sales are a use of cash. What happens on the cash flow statement? Basically, any type of increase in accounts receivable is usually deducted from profit in order to get to cash flow. If the opposite thing happens, if accounts receivable decreases from one year into the next, that means that a lot of customers paid their accounts receivable balances, so they paid their bills. A lot of this cash would have come into your business. Therefore, any type of decrease in accounts receivable is an inflow of cash into your business. Now, the third common adjustment that we see on the cash flow statement is an adjustment for accounts payable. If the accounts payable balance increases from one year into the next, this is typically considered to be an inflow of cash. Why is this? Because essentially what you're doing is borrowing money from your suppliers. This cash inflow is typically added to profit in order to calculate cash flow. If the accounts payable balance decreases from one year into the next, that means what you've done is paid down a lot of the bills that you had outstanding from your suppliers. If you're paying bills, that is a cash outflow from your business. Basically, what you will do is you will go to the cash flow statement and take profit and remove any type of decrease that you have in accounts payable because that is a cash outflow for your business. Because we're all about real world examples on this channel, let's look at Apple's balance sheet and cash flow statement to understand some of these movements.
All right, so let's look at some of the movements on the balance sheet and how that affects cash flow. So if we start with accounts receivable first, you can see that in 2020, Apple had $16 billion outstanding for accounts receivable. In 2021, that balance increased to $26 billion. So roughly a $10 billion increase year over year. If you go to the cash flow statement, you should see that the increase in accounts receivable year over year is removed when calculating cash flow, because when accounts receivable increases, it's a use of cash. And you can see that right here, how the removing the increase in cash is basically removed from profit because this is a use of cash in order to calculate cash flow. So you can see that $10 billion was removed. Now, if we go back to the balance sheet, let's look at another category. Let's take a look at inventory. Last year, Apple had about $4 billion in inventory. This year, 2021, Apple had about $6.5 billion. So you could say inventories increased by $2.5 billion approximately. Now, again, as I mentioned, anytime inventory increases, you're using cash to buy this inventory. Therefore, it is a use of cash. So again, very similar to accounts receivable, we should see that there is a deduction for the increase in inventory on the cash flow statement by taking profit, removing the use of cash for inventory, and then coming down to calculate cash flow. Last but certainly not least, if you look at accounts payable, last year Apple had $42 billion outstanding of accounts payable. This year, 2021, they have $54 billion. So basically, they increased accounts payable from 2020 to 2021. Anytime there's an increase in accounts payable, you're basically borrowing more money from suppliers. So this is a cash inflow to your business. And you can see that here, because accounts payable increased by $12 billion year over year, it is actually added on the cash flow statement, basically adjusting profit, adding the cash inflow from accounts payable to then calculate cash flow from operating activities.
Now, one of the ways that I like to sort of understand working capital and wrap my head around the concept is by looking at acquisitions. Typically, when you're buying a company, you pay the seller the purchase price that they're asking for. And on top of that, there is usually a working capital adjustment that is added to the purchase price. Now, why do we do this? It's because any type of seller that is selling you the company usually leaves things like cash, accounts receivable, and inventory in the company before they hand you the keys as the buyer. If you think about these three items, if a seller is going to leave cash behind, that's cash that the seller has earned while they were running the company. Hence, you as a buyer are inheriting their position, therefore the seller needs to be compensated for leaving this cash balance behind for you. If they're also leaving things like accounts receivable and inventory, like I mentioned in the beginning of this video, accounts receivable and inventory could be turned to cash. Accounts receivable can basically be collected from your customers, and that is a cash inflow for your business. And inventory can be sold to your customers, and then you can get cash for that inventory that is sold. So bottom line, you're essentially compensating the seller for leaving behind all of these investments that they've made in the company and the money that they've collected up to a certain date that you as a buyer would be benefiting from. If you're a founder or investor that is looking to improve your knowledge of finance and accounting, make sure you subscribe to our channel. We drop videos just like this one every Sunday. See you soon.